Diversification is a way of managing the risk among the investments in a portfolio. Simply put, diversification is when investors increase the diversity of investments in their portfolios to mitigate risk. The common thought behind this strategy is that the overall performance of a portfolio is tied to the performance of the investments that make it up. In an extreme case, take a portfolio that only has an investment in one stock. If that stock suffers a loss, the portfolio suffers a loss. The performance of the portfolio is directly correlated to the performance of that one investment. Now let's look at an example of a portfolio with 100 investments. If in a given year, 20 of the investments produce a negative return, but 80 of the investments produce a positive return, the portfolio will likely yield an overall positive return. The large diversity of investments allows the portfolio to hold some investments that produce negative returns, but produce a positive overall return. One thing to note in this example, if one of the 100 investments does exceptionally well, investors do not benefit as much as they would if that one investment was their only investment. On the other hand, if that one investment does extremely poorly, its loss is offset by the gains from the other investments. In general, most investors are risk-averse, meaning they would rather achieve small gains with certainty than big gains with high levels of risk. So how does one diversify their portfolio? Investors can achieve diversification in many ways. One approach is to invest in many asset classes like stocks, bonds, ETFs, real estate, and commodities, just to name a few. A second approach could be to invest in different industries. A third option could be to invest in foreign or emerging markets. A well-diversified portfolio would contain some level of variety in all three of these approaches and more.